Good evening, ladies and gentlemen. Happy New Year's as we get into a very dynamic discussion today, discussing dividends versus growth. And this has been like an age-old discussion for eons, but I wanted to take it to another level this evening by more or less talking about the two most controversial dividend and growth stocks that pretty much exist out there. No, we're not talking about Tesla. We're going to be diving into Altria Group, one of the sin stock sectors, along with Alibaba. But then we'll take the broad view. We're going to answer a lot of your questions. There's so many Q&As already going on between VOO, VFV, a lot of these ideas, especially from the Canadian perspective of investing these days. I got a lot of other Q&As coming out, and I got a really intriguing interview that I think kicked the year off incredibly well, coming from Steve Eisman. One of the gentlemen from The Big Short was recently, I think, on CNBC, but I got the clip, the first 5 minutes. If you haven't watched it, man, there is so much tidbits of just glorious controversial discussions in there that are highly related to conversations today about growth being overvalued. And if that is a conversation you appreciate, as always, just consider hitting that like button. But before we get into that, I also just want to point out that this week I'm going to have a very intriguing interview with the CEO of Video XRM, a company that I've actually taken some private shares in. This company is utilizing AI through 8,000 plus different attributes to hyper search corporate media. That's something that Google is not doing successfully. They have an AI bot that's integrated. For example, if you want to show the two most recent financial or just some recent videos on Tesla, right? Like, it'll pull them up, and then you can start asking it questions specifically about these videos. So instead of actually having to watch them, you can actually just use the AI bot to break the whole video down, pull up a lot of the highlights. I mean, we're talking about utilizing this to break down everything from quarterly earnings and just the quarterly calls and stuff like that, and so much more in between. So this should be a really fun discussion with somebody that's on the forefront of AI discussions. I did a video on it, and you can see where they're raising capital at netcapital.com. I kind of got the link down below. I'm not telling you to invest in this. It's just something that I'm very intrigued by that should be a fun discussion moving forward. But let's get into the news today. First and foremost, folks, let's take the broad view of the markets, because this is the week where everybody has been getting hit. This has been a pretty abysmal start to the week. And honestly, I'm more than happy to see the markets go down, but I think it's going to be relatively short-lived. I think Steve Eisman is going to make some good points about the optimism in the market today as some of the rotation goes from tech into the healthcare sector. But I just have a hard time believing that the last quarter is going to be that negative, unless we're missing something and quarterly earnings come in at a miss. I'm very intrigued to see how this year kicks off, not from the performance of the stocks and the stock charts, but the performance of the actual earnings of the companies. And this is why I've been getting a lot more bullish on some of these more particular companies, as I kind of give you my end-all be-all bull thesis and why things haven't really changed that much in the last decade. So I'm surprised at how much people are flip-flopping around. And yes, we will talk about HBNK, because my God, a lot of discussions from these Canadian dividend payers, especially these bank ETFs. But yes, I do believe the dividends are eligible. They should be nonetheless. But so yeah, earnings will be weak as F. That is the true defining factor. And I have a hard time believing that, because the trend tends to be your friend. And, with how the records that, e-commerce set, I can't imagine that Amazon is going to post bad numbers, considering how much it's already trading down from the stock price. On the Canadian side of the border, it's more or less flat. It hasn't been as volatile as the US market. We did get a bit of a pullback over the week, but again, when the Canadian markets move, it's usually like 1/3 the movements you see in the US markets. But before we get into these Q&As, we'll get into VFV. We'll talk about the TFSA, RSP, HBank, all these ETFs. I promise you we'll get down that path. But I want to point out kind of these three stock comparisons, because I think they're of the most intriguing to me, because they play in the idea of these controversial ideas of growth versus dividends versus just, the broader S&P 500. And I was into all of these stocks once upon a time. I owned all of these stocks once upon a time when it came to Alibaba and Altria Group, but I ultimately came to a decision that has largely only benefited the returns of my portfolio. Yet I'm seeing investors still contemplate these same decisions today, and I think it's almost detrimental to the long-term growth of their portfolios. I've seen PPC Ian talking about, buying into Altria Group. I've been seeing a lot of Canadian investors kind of doubling up on their idea of Alibaba, and this could be the year for China. And I think as a value investor, it isn't always what matters. The market's pure fugazi, and a lot of this is perception based. And honestly, even though these are incredible value stocks, and again, I think that's still debatable as we look into some of the earnings, we'll break down some of the fundamentals, but I think you have to take into consideration here that there is an incredible amount of speculation beyond how good some of the fundamentals are of these companies. Just because fundamentals are good does not mean the stock is going to perform well. There has to be catalyst, there has to be perception in play. And I've always stated this, and I do like the sin stock sector if you're looking for income. I just wouldn't invest in something like Altria Group. I love British American Tobacco, more globally diversified, more growth. And I always get a lot of hate. I used to get a lot of unsubscribes when I talk about MO, but as somebody that has followed MO for the last several years of my investing career, I've learned one thing. The management likes to increase their salaries while lowering the future potential of the company because they've invested in everything that has only been failures. Everything from Jewel to Kronos Group. This company hasn't done one successful thing in the last 6 years. And the only thing they really have is like Copenhagen and some chewable, products that seem, or like, the pouch products that are orally taken that seem to be doing anything, but it is not nearly to the benefit of shareholders and the growth that is required to make up for the lack of people quitting tobacco. There is going to be an inflection point. There are more people quitting year over year that is compounding at an accelerated rate. There's a lot of risk with these companies that people are getting caught up in the 9.45% yield in. And the stock, yet again, even though trading at somewhat, again, I'm debating on whether this 8 PE is even becoming favorable anymore, because when you go into the fundamentals these days, they're not what they used to be. I mean, if we just take a look at the assets, which I find most intriguing here, is they're sitting on about 36 billion in assets, down from 49 billion since 2019. They've done nothing but decline their asset base. Meanwhile, their liabilities now have surpassed their assets. They have 39 billion in total liabilities and 36 billion in total assets. I just don't understand how we continually come to the same conclusion that this declining business is a good investment, especially for early on investors looking for total returns. Now, in contrast, I know this is like a favorite dividend stock of the people that are, out there. And sorry, I should have shared this screen here just to show you. You can go in MO and just look. Like, as a value investor, this is not what you want to see in a business. It starts to look more and more abysmal over time, right? And I don't think this is the same for all these companies. British American Tobacco, I think, is doing much, much better than Altria Group at a global level because the U.S. is just getting hindered by further regulations. People and the government's trying to step in and get people to quit smoking. But even though this trades at a PE of 8, even though they can afford the dividend, even though they have great cash flows today, you have to recognize that the future of the business does not look that exciting in this moment. And that perception has led to a cheaper value in the stock. Now, if they could do something and turn the business around, I don't even think that matters. And the reason that doesn't matter is because institutions will never touch these kind of businesses again. We're living in a new era where if you do not get institutional ownership, you will not get any movement in the stock by any, substantial way, because Tesla's the only company I think that successfully garnered so much retail investments, from the meme days almost of 2021 there, when like GME was purely trading off retail investors. But I mean, it's also interesting that it seems to be held by 60% institutional ownership. But when we're talking about institutional ownership, I don't think we're talking about funds outside of SCHD and VYM, because it's kind of crazy that for 60% stock ownership, it's just, there's no way this is purely the growth side of this company. I have such a hard time believing it. Insiders own nothing anymore. There's just, like I said, for a stock to be trading this far down for 60% ownership in institutions, I just don't trust any of it at this point. I always try and see how the company will be in 20 years. MO, I cannot see doing well in 20 years with countries slowly banning their products. It's not even that countries are slowly banning their products. Like tobacco, I think the drug sector, it's always going to be around. It's just how people are consuming those drugs. And it's not in combustibles. Like the vape market's growing exponentially right now. It's just MO's never been able to capture it. But again, I always just find it odd that with all this institutional ownership, the stock's done nothing but go down. It's not like the company's diluted or anything like that. You look at their profit margins, they're incredible. I mean, from a balance sheet perspective, assets minus liability is not good looking, and that's truly a sign of management. But from everything else, it's a great company, right? So if you're looking for cash flow, the payout ratio sits at 77%. You can get a full rate of return from the dividend. But the problem is, why does the stock continually bleed over time? And I think that's because major institutionals, like, you're just not going to see this in a pension fund. Like when you see stocks in a pension fund, like that's how mega cap companies have been able to grow. MO, I don't think is going to end up ever in a pension fund. I think these are just held by dividend ETFs that don't have a material impact on the stock, right? So in contrast, I mean, we could talk about something like Alibaba, right? Now, Alibaba falling in the same kind of boat of a perception-based company, this one actually has a really intriguing aspect behind it. I think they just started paying a dividend, didn't they? Or was it a one-time dividend? I don't know. But when you look at the long-term perspective of this, the stock has been absolutely abysmal because of the controversies between China and the US. And I don't know if that's going away with all the bans going on with chips or whatever. But the crazy thing is this is probably one of the cheapest tech companies you'll ever come by. You look at their assets minus liabilities, they're in an incredible place where I kind of converted this. If you minus their assets into liabilities and convert it to US dollars, I think, if I'm not incorrect, they're sitting on about $160 billion in assets, whereas their total market cap is 185 billion. So they're trading at an incredible value. I mean, you take a look at everything about this company right now. I mean, it's in a really fascinating place. But again, fundamentals are not the entire story. You look at the growth here. Can I bring up, why isn't it showing me the charts here? I really want to show you guys the growth on this company if it loads. I mean, you just take a look at this chart over here and look at the quarterly growth or yearly, and then you come into quarterly, and the company is still growing at a really good rate. They're beating earnings expectations from 509, what is that, trillion yuan, if that's, or billion yuan, whatever the CNY is here. Got to do a bit of conversion. But I mean, the company's basically doubled their revenues in just a mere 3 years, almost 3 years expected. It's kind of nuts. When you really consider everything here, and their gross profit is, gone up pretty dramatically here as well. It's just a matter of, why don't investors care about that? Well, because China, right? I mean, it makes it almost uninvestable, and it's really hindered your returns if you utilized it as a value play. I mean, we've seen a lot of investors take, keen to these kind of stocks like everything money. And I've told you guys relentlessly, you have to be super careful because the markets are truly fugazi. And unless the perception of these companies change, it's insane how the stocks can't grow, even though the fundamentals do grow. This is why I also hate people that crap on dividends, because at least dividends are cash flow coming from an operating business that allow you to either reinvest in the business or diversify your portfolio without having to sell the shares. Because just because a company is growing their cash flow and earnings does not mean the stock is going to go up, which means if you're in retirement, it is very, very hard to positively cash flow off a stock like this. So you got to understand that there's just a lot at play with companies like this. And when it comes to growth, I really want to state that it has been the true and tried story that is yet to change. And I see a lot of people crapping right now on the Magnificent Seven. And I do believe there are some overvalued stocks there. I mean, they're expensive, right? They're not cheap. But when you look at the future of these companies, and we could go through some hiccups in the next year or two until the interest rate cut cycle comes into play. And that's also a fascinating discussion, because as much as I believe, some of these dividend players and infrastructure companies will be some of the best recovery stocks after they start cutting interest rates, what do you think is going to happen to a company like Google when people can take out debt to fund their marketing all of a sudden? And I know there's a lot of discussion too around venture capital and small caps and everything else, but that same discussion still applies to the Magnificent Seven. And I also just think it's interesting that, people are really just kind of harping on those stocks today, even though that has been what's worked for the last 10 or 15 years. And people take that into consideration with the S&P 500. I'm seeing a lot of big YouTubers that blow my mind at the ignorance when they say, the S&P 500, it's you should be buying it because it's heavily leveraged in tech and the Magnificent Seven. It's like, yes, but the S&P 500, especially Vanguard's VOO or SPY, are passively weighted systems. You are not just buying those 7 tech companies. You are buying a system that will wait and decide what companies can take their place if something else does come into fruition. If you want to gamble and try and outperform the market, you can gamble on speculating on the lower half like I'm doing and hoping that they have a nice recovery and give some outsized returns. But eventually that'll hit parity, and then you're relying on the future of growth. And these companies aren't pronounced for growth. Just because they're cheap today, they could give an outsized return. But I still bet you that Amazon over the next 10 years is likely going to outgrow a traditional bank stock, even if you're buying that bank stock at a good value today. So I just think it's wrong to be leading investors down this path of constantly just setting people down these spiraled holes that usually just don't work. And I believe small caps have real potential here. I believe there's a lot of good companies out there that can offer really great returns, but in the long run, they're not going to offer the same return as a company like Tesla if they can make robots and self-driving cars. Tesla's valuation is completely justified if they actually had a revenue generative business off self-driving cars tomorrow. People just keep forgetting that in the valuation, right? That's why I sit on the sidelines, because without that, there's a lot of volatility in that. But there's an inevitability. No one's doubting that one day cars are just going to drive themselves, and there's going to be a lot of robotics taking over heavy machinery and dangerous jobs. Like that's going to happen. And what that value is going to have on the companies that succeed in it are going to be exponential. And it might not be Tesla, right? But you want to have exposure, and the S&P is going to do that for you with very little risk. Well, there's always risk, but You know what I mean by passively weighting the best companies, right? So let's just go through some of these Q&As real quick. And then I just want to discuss, we'll take in some, the overvalued 7. You can say they're overvalued, but I'm telling you, people have said Apple's been overvalued for the last 6, 7 or years I invested in it. I've been hearing that forever, right? And they are expensive companies, but they are very expensive for a reason, because their growth potential has been able to be proven time and time again. Now that could change. That could obviously change at any time, but that's why you diversify. That's why I try and, get a good separation of dividend income and growth, because you can't just pick one or the other, because growth, again, through 2022 was absolutely detrimental. But I don't know. It's a tough discussion. A lot of people have been beating themselves up about, right? But I just want to answer some of these Q&As real quick, because there's some really good comments and questions. And then we're going to listen to Steve Eisman, because man, oh man, did that guy put a lot of good sense, I think, into the conversation that we're having right here, right? So a lot of people are saying, hey, I want to start investing in ETFs, especially VFE or VOO. Any advice on how to get over the mental hurdle of investing in an ETF that is having an all-time high? Since I usually try to invest when the stocks are relatively down or cheap. I'm having a hard time buying at these times. And this is a fascinating discussion, because I've come up with a pretty good plan that works for this, which is you always have an investment emergency fund. For instance, I always leave about 10 to 20,000 just sitting around that I will not invest, that is not part of my emergency fund, but it is part of my investing emergency fund. So when the market goes sky high like it is right now, like I am just investing the money that I have as income. And I'll keep investing that income. But if the market tanked 10% over the next couple months, like I'm going to take some of that investment emergency fund and start doubling or tripling up my investments while the market's down. But if you have a hard time investing when the market's at all-time highs, just zoom out and look at the last 10 years. You'll realize the market was hitting an all-time high pretty much consecutively every year for 10 years. It really kind of makes you realize that buying it isn't that hard. Why choose VOO over VFV? Because it gets paid in US dollars and VOO has a lower MER. Now, a lot of people have been discussing this already before we went live. If I scroll all the way back up here, my God, you guys have been having one hell of a conversation these days in the chats. But yeah, it was fascinating because there are higher fees. A lot of people complain because you have to pay the initial conversion fee on the US conversion if you're buying VOO, whereas VFV has a higher expense ratio, and I don't think it's by much. I mean, how high is VFV's expense ratio over, say, VOO? I don't think it's significantly higher. And I think there's also some concerns on the dividend because the ETF auto has to do some of the withholding. But yeah, you're paying about 0.08, which again is still like incremental in comparison, but VOO is giving you what? VOO is giving you a total cost of, if it loads here, 0.03. So again, we're talking about incremental amounts, and this is really dependent on your personal goals and what you want in life. But for me, I'm somebody, you don't have to be like me. I think VFV is a great ETF to buy. It's simple without conversions and fees and bull crap. But I'm somebody that truly believes I just want to own US dollars. I like US dollars. I like spending US dollars as a Canadian. The fact that I can own businesses that pay me USD, I'd much rather just own the native currency of the US rather than constantly converting everything to CAD. Because even in Canada, you can spend US dollars. Most of my money's in the US and it's all in US dollars. And I can pull it out of my TFSA into my US accounts. My corporation trades in US dollars. Heck, I work for US companies that pay me in US dollars. It's really odd that you can live in a country like this and have those capabilities. But I am somebody that just believes that the US will outperform and continues to. So I'd rather just keep it as native as humanly possible. But that's just me. You don't have to be like that. And the reason that VFE is outperformed is because it's showing you the dollar conversion already. It auto converts the currency into the stock, right? So I noticed VFV already is sitting at a relative all-time high. It's up 3.3%, whereas VOO from that all-time high incomparable because it's not converting the currency. Whereas if you sold it off and converted the currency, you'd see the difference, but it's actually down 1.5%. So you'd think if I held VOO in US dollars, it'd look like I'm down 1.5%, but if I ever converted the currency, I'd probably be up just because of the conversion and how long I've held US assets for in my portfolio, right? So it's an intriguing conversation. How do you pick ETFs? Why VOO, BNK, or HBNK, the Canadian, equal weight bank ETF? Aren't there so many hidden fees with these? Any tips on where to research the rates to ETFs to start for newbies? Firstly, I think, again, after investing for 8 years, you come to the rapid conclusion that there are very few good ETFs. There are very few good mutual funds. It is actually surprising at how many people will pick bad underperforming ETFs. And that doesn't mean that, there's a guarantee the S&P goes up. I mean, a lot of countries struggle, right? And a lot of people want to over diversify into like global market funds. But honestly, I think when it comes down to it, it's just really, it really just amplifies that, VOO has been one of the longest tried and true. It is the benchmark. It is what everyone compares themselves to. It is the bet that Warren Buffett made that over a 10-year period, I will bet you $1 million that you cannot, outperform one of these S&P 500 ETFs. One hedge fund, I think, took them on, and then after 7 years, they threw the towel in. It is just the end all be all. And even Berkshire owns SPY, in their portfolio, and they have. And I don't know if they just use it as a benchmark or against their stocks, but it is, the king crowned of all investments, right? And it is offered a very healthy 12% annualized return, I think, since its inception, which is insane, and it's very hard to match. Whereas HBNK for me is just, like I said, I want outperformance, and if you're buying foreign stocks, you have to be a little bit more cautious. And HBNK into the Canadian markets, I think just the banks have historically always outperformed. And HBNK right now has a zero management fee for the next 6 months because it's a new ETF, and they're only going to charge 0.09%, which is pretty much as much as VFV. HBNK is going to take over the Canadian bank ETFs because right now ZEB, that one has been the dominating one, but I think it's going to lose its crown here because of the management fee, right? Like ZEB is charging an arm and a leg in comparison at 0.25%, I believe, is the management fee on this ETF. So when you do research, you're going to realize very quickly that when you backdate a lot of these ETFs, there are just very, very few that have done very well over a long period of time. And you're going to go down that path of looking at, and I get those questions a lot when it comes to, these option ETFs. I've only found 1 or 2 option ETFs that have actually performed exceptionally well. And that's only because they've been Canadian dollar hedged. It's really shocking at how many people love income ETFs, yet just don't care about total return. And they're very young, and they're like, I'm going to be able to retire tomorrow, until they realize that, they would have retired a lot quicker if they just bought an S&P 500 ETF that yielded 12 annualized percent instead of 5 or 6. Because a lot of option ETFs only annualize 5 or 6%, and they don't have a long track record. Honestly, if you're going to buy an option ETF, you should learn how to write the options yourself. It's something that I stated. If you don't know how to write a call option, collect the premium, then you shouldn't be buying an option ETF to do it for you. Because you can very easily, instead of paying a super high management fee, which they're usually half a percentage point, to just have somebody do it yourself and write it against the S&P 500. Very safe way of getting covered call premiums, right? Why not use Wealthsimple for your Canadian bank shares? No commission, whether you buy 1 share or 1,000 shares. This has been a conversation of choice for a very long time. And maybe one of you can enlighten me, because the reason I do not use Wealthsimple, even though it is the only Canadian platform with commission-free trading, is because they will not let me buy U.S. stocks in U.S. dollars and hold a U.S. account and convert the currency without paying an arm and a leg. You think the banks are expensive? Imagine buying a U.S. dividend stock where you can only buy it and have it convert the dividend. You can't really own it. I don't know. I've heard that they were going to change that. I just, because I do so much foreign currency stuff, I found Wealthsimple, that was their biggest detriment, and it just turned me off from the platform. I'd rather pay the bank a $10 commission and just do a big trade for, $1,000 to $5,000 instead of dicking around with small trades. If you're just a small, and again, not belittling in any way, but if you are a small investor and you're investing, you're trying to invest 20, 50, $100 a week, and you're just starting out, use Wealthsimple. You can buy Canadian CDRs where you get US stocks, but they're in the Canadian, trading the TSX. They're like US represented stocks like Tesla and Apple and all those companies, but you can buy them within CDRs or buy VFV, right? VFV is a great thing you can do really easily without currency conversion. But as somebody that likes currency conversion, Wealthsimple dramatically falls short on that aspect of things. But I think Wealthsimple's great. It's the only Canadian platform that I think has really helped out Canadians not get screwed by the banks that charge way, way too much in fees. But let me know if you do currency conversion. Has Wealthsimple fixed that? Because the last I call, I don't think they have. Why HB&K and not HCAL or HMAX? So we discussed this. We just discussed this when we're talking about covered call ETFs. Like HMAX, you just lose so much upside, right? I mean, you take a look, and yeah, the thing has recovered a little bit here. It's up 10% since the bottom, but the bank stocks are up way more. And since this thing is still down 14%. It's just, these are covered call ETFs, guys. You lose so much to management fees over time, and they lackluster so much. And it disappoints me how much people love these ETFs. You should always backdate for at least 10 years. You don't got 10-year performance charts and stuff like that. Be very careful about what you're buying. I feel the S&P will underperform for a while. The biggest holdings are the Magnificent Seven, and they are mostly valued right now. And 2024 will see mid and small caps catch up this year. The big guys cannot keep going up at this rate. So this is the funny thing, right? Like, now, don't get me wrong. I agree with this statement, but I also agree that it's heavily speculative and it leads you away from the best performing stocks, because the fact of the matter is the Magnificent Seven aren't up that much. I mean, if you take a look, Google is not at an all-time high. But I mean, I can show you a lot of lower end companies that are at all-time highs. I think American Express, I mean, there's some lower end, like JP Morgan's come back a lot. There's a lot of lower end companies that have almost fully recovered, but there are a lot of Magnificent Seven companies that haven't either. And again, you can justify some of this rally. I mean, you look at NVIDIA, for example, right? Doesn't mean NVIDIA is going to perform like it has forever, but if it keeps performing the way it has for another year, I can justify a 64 times multiple. The stock can continue to go up, right? So I think it's a fallacy to chase, to presume that these stocks are overvalued, because if you said that any time in the last 10 years, you've been wickedly wrong, and you could still be wickedly wrong into the future. So don't just buy lower end companies and forget tech stocks, right? That's why I'm always cost averaging the S&P, and that's why I would rather hand select some of the tech companies. But keep in mind, when I say hand select, it sounds kind of stupid because my fiance and I have exposure to tech companies. We own Meta, we own Apple, we've owned these companies individually since pretty much the inception of our investing careers. And they've done us excessively well, and they continue to, right? It's just a matter of continually cost averaging and diversifying where you think some value is to try and get continued outperformance. But I haven't seen that outperformance, right? Like, I've been buying bank stocks for a while, for most of my investing career, and they've never outperformed tech companies. So I think buying them down here, you could get, again, outsized returns, but eventually that's going to stall out because banks can only grow so much. And I think what we're going to pay most attention to in the conversation that will be of choice is when they start cutting interest rates, where's this money going to go? There is about $6.1 trillion as of Q3 2023 sitting in money market funds. This is going to stall out. This is where there is an insane amount of money that is going to find its way back into the market, and where this money goes is going to be fascinating, because I think the total value of what the U.S., what's the total value of the U.S. stock market? I think it's around 40 trillion. I could be wrong. Yeah, $46 trillion. So think of it that way. There's $46 trillion sitting in the S&P pretty much, or the U.S. markets, right? And there is 6.1 trillion just sitting here on the sidelines in money market funds, a record amount pretty much since 2020. Or pretty much as of recently, really. I mean, a lot of that money, probably another trillion of it, only just came into fruition since people were running away from their investments, right? But I think if we go back down to a low interest rate environment, even 4%, 3%, if we start getting back down to those numbers, this money's going to go somewhere. And I think it's going to lead us into the next bull run as the economy starts to recover. I think the next 2 years is going to be a huge recovery story. And I think it's going to be foolish to turn your head away from growth stocks and dividend stocks, because both are going to benefit dramatically from this cash, from a lower interest rate environment. And you're going to see it come back into the economy, presuming there's no black swan event that wipes this out. Got to be a little careful. You never know what happens. This is why my parents, when we're building out their investment portfolio, you always have to presume the worst. So we keep a percentage of their invested capital in high interest savings accounts, because I can still get 5%. But our plan is, as soon as they start hinting that they're going to cut the interest rates, we're going to buy 1, 3, and probably 5-year GICs and lock up that 5% for as long as you can, because that really protects a retirement portfolio. Because again, you don't want to go into a 2008. You never know when a dot-com bubble hits. Nobody ever knows when that stuff is coming. It just happens. And if you're in retirement, it really sucks when your portfolio drops 50%. But you can't own stocks and presume they're going to go up forever. And there will come a time where they drop. You just got to be diligent enough to buy. But in retirement, you might not be able to buy. So you need to make sure you have some kind of cash and fixed assets, right? But that's going to be the story of 2023 or 2024 and 2025. Where does this money go, and what happens when we cut interest rates? And leading into that story, you got to listen to Steve Eisman, man. This is effing brilliant. The first 5 minutes of this discussion, I think, really resemble a lot of what we've been discussing here.
2024, an investor known for The Big Short, questions whether we are still too bullish. Steve Eisman is senior portfolio manager at Neuberger Berman. Steve, welcome to the show. Happy New Year to you.
Thank you. I'm honored to be here on your first show.
So you think that market fundamentals are actually good, but overall sentiment is too bullish? How do you distinguish?
Well, I mean, think of it this way. Let's say we were here a year ago. Most of your guests would have come in and said the earnings of the S&P are going to be down. the market's going to be down. The economy is going to go into a recession in about 15 seconds. And none of that happened. The recession that never was.
Yes, sir.
And so the market climbed the wall of worry the whole year. So now here we are a year later, and everybody is, including me, has a pretty benign view of the economy. The only thing that bothers me is just that I don't think we're necessarily wrong on the economy. I think we're probably right. It's just everybody's coming to the year so bullish that if there are any disappointments, what's going to hold the market up? But
see, that's the thing he's discussing, and what I'm saying. Earnings are going to be the defining factor of the market. If we get disappointing earnings, we will see a crazy pullback because it'll ruin that perception and that optimism that has been driving, this growth, right? And how strong this truly is. And you got to understand the marvel that is the recovery. Because we did not get a real recession yet. This is the first soft landing pretty much ever in a tightening cycle. So, I mean, it's very fascinating, and it should show the strength, and it'll be really intriguing what earnings.
I think long term, I'm still very bullish, but near term, I just worry that everybody's coming to the year, feeling too good.
We're having a whole conversation about Apple and how the markets might need to discriminate, within big cap technology. How do you feel about the backdrop of the economy with the Magnificent Seven? Is it time for rotation? Is this the backdrop to rotate into lower PE stocks, or does that not matter to you?
I don't focus on that much. I still think, the Magnificent, you have to have at least a significant percentage of your assets in the Magnificent Seven. There are other themes that we also really talk to our investors about, like infrastructure. 1.2 trillion is still going to get spent in the United States over the next 10 years. First time we've had a industrial policy in the United States of America, probably since anybody in this room has been alive. So that's a big theme. So I think people underestimate that as well, right? Like the government is still stimulating the economy, and they're stimulating it in infrastructure. And you've heard a lot of big investors talk about investing in companies that are going to benefit from the government grants when they're talking about rebuilding a lot of infrastructure, renewable energy stuff. So there's going to be a lot of money flooding into the market still, and those stocks are going to benefit greatly from that cash advance. A lot of good things going forward in the market. Just start the year psychologically, everybody is just a little too freaking happy.
Well, so a place where you haven't been terribly happy, and we want to hear, most investors, when you talk about banks, people want to listen. You've got a noted storied history. Well, you've made some great calls, some very successful calls on the banking sector. And I think probably 3 months ago, you said somewhere, in the context of probably a much bigger conversation, but that banks were not investable.
That was the best thing ever, because I told you all that he was wrong. The banks were buying opportunity of a lifetime. Heck, I mean, we were just joking about, well, how much does SCHD like W come back? There's been so much recovery. I mean, if you bought that back when he was complaining about it, I think the Schwab, corporation one is up 34%. Hell, JP Morgan is up an arm and a leg right now. How much has JP Morgan gone up from the lows? I mean, it's up like 64%. I think Bank of America was struggling a little bit, wasn't it? But these banks have, the day he basically said they were uninvestable, they did nothing but go up, which was hilarious.
And I think if we're going to get the market to rally further from here, we need the participation of banks. So just touch base on banks at the start of this year.
So, I mean, let's pick on one bank. I mean, and I have no position in this bank, and I have nothing against the company. It's like Bank of America. So Bank of America is a very well-run bank. It's got a very good CEO. That doesn't mean they haven't made mistakes. They bought a hell of a lot of long-term bonds at the wrong point in the cycle. It's not a balance sheet problem. It's more of an earnings problem. So the earnings, if you look, are basically flattish for the last few years, up and down by just a little bit percentage. So how are you going to make money in Bank of America?
So that's a good point, right? And this is what I've been stating, but I'm more or less fixated on the Canadian banks, and the Canadian banks have a big problem of loan loss provisions. A lot of the US banks are going through that issue as well. Clearly, this guy's a little bit more advanced on understanding the purchase of their bonds and stuff like that, which was a concern. But for me, the Canadian banks have been making a lot of them record revenues. And as soon as they're done putting loan loss provisions aside, like he said, the banks are following earnings, and the stocks have literally trended in the way earnings have, and that's about to bottom out. And those stocks are going to rebound as the earnings recover. I can almost feel like it's a guarantee. Like if there was a bet that I could make that was damn near close to a guarantee, was buying those banks when I was saying in the October low, right?
Okay. You're going to need really two things. You're going to need the Fed to cut rates, so that'll help people's perception of the balance sheet. And you need no recession, so benign credit. Now, could that happen? Sure. But I'm actually of the view, the market seems to think the Fed's going to cut rates at least 3 times this year. at this point don't have that view. I think the Fed is still petrified of making the mistake that Volcker made in the early 80s, where he stopped raising rates and inflation got out of control again. So I'm not that bullish on the Fed cutting rates. And if that's correct, I think it's going to be hard to make money in the major money center banks. Now, that's not.
So even outside of the central banks, this is going to be the discussion of 2024. I mean, market down now, interest rates, as much as we talked about them last year, will be an even bigger discussion this year, because not only is it, are they going to cut? We know they're going to cut, but how much are they going to cut? And honestly, I think they should cut them more rapidly than slowly, because I think inflation is dead. I think it was proven that inflation was from money printing, and lowering the rates isn't going to sky high inflation. It might bring assets back, but it's going to make it more, I don't even know. I really feel like the economy is in a worse place with higher interest. Now, don't go back to zero, but we could probably come back closer to 4%. There's a lot of guests being around 4.25 or 4.5. We'll see, but I think he's right. I think Jerome Powell is going to take this so slow that it's going to be underwhelming how fast they cut interest rates. And if that is the case, then I think it's going to be a bit of a slower grind for some of these infrastructure companies, but we will start to see the recovery into 2025.
Not a company specific call. That's a real macro-y call. It's hard to, make a long-term investment case for the banks when you have to deal with so many macro factors like that.
I disagree.
Steve, as we sit here, U.S. debt just went over 34 trillion today. Is there a scenario where there's a debt problem in 2024, some sort of credit crisis that you're looking at?
100% no.
100% no.
No. In our business, we like to say being too early is the equivalent of being wrong. And there have been plenty of times in my career where I've been too early, but I'm not 40 years too early. The people who are making this argument about U.S. debt have literally been making this argument for the last 30 to 40 years. And they're still making it. And they're telling you to buy Bitcoin because of it. And, my attitude is when you're 40 years too early, have a little freaking humility and keep your mouth shut. So there's absolutely no evidence whatsoever that the dollar is going to lose its reserve currency status. People still want to buy U.S. debt. They're not replacing it with Chinese debt. So, until there's a real problem in the U.S. bond market, I think we're just fine.
Now, I want to show you guys, because it finishes up and he goes into some talking about his nice getup, but I want to show you the DXY, because I think the most impressive thing about this current collapse in the market is the fact that the US dollar has actually been stronger than it has with all the money printing, with almost doubling the money supply. We are actually at the strongest dollar we've seen since the dot-com. And I don't know, again, I'm not using that as a reflection that we're in a bubble, but I'm just saying, it is astounding the global dominance the US dollar has, even with the astounding amount of money printing they have done in the last year. I mean, it's a marvel, man. This is why I like owning US dollars, because the rate of growth of this over the last 10 years and the strength and the money that has been flowing into US assets and the trading volume in US dollars globally continues to persist at levels that, again, people say it's the end of the dollar, but you have a hard time believing that, right? But nonetheless, let's get into some Q&As real quick. Yes, I hope you hit that like button. I appreciate the 100 of you that have been jumping into this as we just finished up with a few Q&As, because man, oh man, I love doing these weekly live streams to kick off the year. There's commission freeze. A lot of you talking about Questrade, the best Canadian trading platform. Yes, I do believe is probably Questrade or Interactive Brokers. Again, I'm using I told you guys, I use every bank, so I don't really care. I mean, we use primarily TD, Bank of Nova Scotia. We use Canadian Imperial Bank for some of our stock trading. I use all of them. I use Royal Bank. I literally use every bank except for BMO and National Bank, but I pretty much use every major bank. So you just pick whatever works for you. But honestly, for lower trades, I think Questrade has $5 trading commissions, and just use Wealthsimple. I mean, if you're new to investing, best thing you'll do, it'll save you some time, and that seems to be your conversation of choice. My God. That's quite, you guys are just going on and on about the fees and the banks. I believe, once you have 100,000, maybe you can become special with Wealthsimple. I honestly don't know, because I have 100K in most of my accounts, and they don't give me any special qualities. I find they if anything, they want to charge me more for other things. Just not paying. I hate paying bank fees on savings accounts. I hate that you have to have a minimum 3,000 to 10,000 depending on the accounts you own. Even in my US bank account, I have to have a minimum of $4,000 in my USD account, or they'll charge charge me, and this isn't my corporate account, but they'll charge me like $10 a month. Whereas in like Bank of Nova Scotia, the minimum is $200 US. So they'll charge me a monthly fee. Very odd how these banks work that way, but hey, at least it keeps me in some cash, right? VOO 0.03. Yeah, index funds will always outperform REITs. I honestly think REITs for the recovery are going to be nice, but as a long-term investment, they're good for cash flow, but not, I think, good for astounding returns. I've noticed it's one of the hardest sectors. Like, let's just take a quick look. Like, there's one stock that I love a lot, but it doesn't matter what your favorite REITs are. There's only been a couple that have truly outpaced the market. And even those ones have corrected a lot, but they're starting to rebound, right? Like Stag Industrial is one that I've liked a lot, but you look at over the last 5 years and it's not been like astounding. It really gave up a lot of the growth, but the big ones are like Crown Castle, these REITs that focus more or less on basically like telecommunications, because they're just buying land and renting it out to basically telecom giants. And even these ones had a wicked correction as of recent. I mean, you look at the last 5 years compared to the S&P 500 and you've wiped out all of those gains. American Towers, I think, was the largest American REIT. And this one, I think, has more of a recovery. Sorry, American Towers. This one's had a lot more of a recovery, I believe, since I last checked. Yeah, it bounced up quite a nice little bit there. It's up about 34%. 5 years is a lot nicer, but these are some of the biggest REITs. And over time, they had great performance. But as of recent, if you bought these, I mean, you've underperformed. I mean, what? So 5 years, VOO is up what in 5 years? It just shows you how truly hard investing is. I mean, you could have just bought VOO. You've been up 80% versus the 32% in American Towers. But I think these can be a proponent in your portfolio. If you think there's value, play them for the growth. But I would have to actualize the capital gains, because if you think this is, again, like if you're buying recovery stocks, recognize that if they do recover and you get a nice good gain out of it, that you should reallocate, take profits, and consistently manage your portfolio. Because I find a lot of people buy good stocks, they go up a lot and they never take profit and they never diversify, and they end up running into situations like this where the stock can drop and then it never comes back. Like MO, right? Like once upon a time, MO was a great company, but if you made it a huge percentage of your portfolio, because let's say you bought MO back in the early 2012, you would have rode it all the way up 100% plus crazy dividend growth. You'd been on top of the world, and maybe it became 20 or 15% of your portfolio. And you're like, this is the best thing I ever did. And now all of a sudden the stock's done nothing but offer zero return since 2017. How many years is that? 18, 19, 20, 21, 22, 23, 27 years. Could you imagine owning a stock for 7 years? I mean, after a while, you have to recognize that there's something that isn't right about the investment, right? But that's just me probably being a little bit cynical about it. Back then, they were just buying whatever Uncle Ed felt like to generate a yield. There wasn't a coherent strategy. RioCan has growth plan now. And so honestly, Canadian REITs and all REITs trade at wicked discounts. I think the craziest thing about the real estate market is disconnected from the fundamental reality of the real estate. Because honestly, if you were a true billionaire, what I would do right now is try and go and buy REITs outright, own them until we get into interest rate cut cycles, and then sell all the real estate off, because they all trade below asset value. I mean, I can't find like one Canadian REIT that actually trades at its NAV value. I think RioCan's NAV value is something like $24-25, and it's trading for what right now? I mean, RioCan is trading at, these stocks, they just never trade at their NAV values. It's the weirdest thing about real estate is that it doesn't need to trade at its actual fundamental value. I mean, there's people out there that do that for a living, right? Like they buy companies going bankrupt. They have experts go in and analyze the value of the company's assets, and they say we're better off liquidating the company than owning it, but we're going to buy it at a discounted value than liquidate the assets. And you get hostile takeovers and all kinds of crazy crap. And I feel like that's the REIT sector right now. It's just like, I don't get it. They just it's a really scary thing. Whereas if you just buy rental property, you could sell it at market value and actualize whatever the asset's actually worth in that moment. But yeah, I bought RioCan May 1st. If you bought it, oh my God, you've owned it since 2005, and it's paid me $19. It paid $19.50 a share today, almost 19 years later, and it trades for $18.97, whereas is less than I paid. Many REITs are like this with little growth. Yeah, that's the scary thing, right? It's very hard getting long-term growth, and I think that's because of the ghost fees when it comes to management and a lot of other things. PPC Ian just covered Altria stock, and also looks like something to look into. So I don't know, you came into the stream early, but yeah, I hope I didn't turn you off from Altria Group. I just honestly think it's one of the worst abysmal stocks you can own. I mean, the assets and liabilities are garbage. The cash flow is fine. And PPC Ian said he was investing in the brand Copenhagen and that stuff, but those brands have deteriorated. It's like the big fear with companies like Pepsi right now. I mean, look at Pepsi and Procter and Gamble and those companies. Like, you have to understand things are changing in the world. Like, I don't go to parties anymore and see Doritos. I mean, when I was a kid, Doritos were everywhere, but we don't even buy that crap anymore because it's just so damn expensive. And you see them fighting for margin today. Like, Pepsi just isn't growing like it was, and they're fighting, man, because their products, they thought they could raise the price infinitely, and they're learning very quickly that people don't want to pay insane fees for just chips when there's much better, cheaper alternatives out there, right? Don't get me wrong. I can't even remember the last time I ate Doritos. In fact, I dipped into Hershey's there. I think Hershey still owns, or at least they have some kind of rights with, mini eggs. And the first time I bought mini eggs in like 2 years was only because they were on sale after Christmas. I think we were buying the big bags for like $3. But yeah, I don't know if everyone thinks like us, but we do not buy this crap anymore. It's not like our childhood, right? So you got to be scared of that. Same with Procter and Gamble. Like, Procter and Gamble's crushed it for a long time, but you just saw Warren Buffett sell it. Why would Warren Buffett sell Procter and Gamble? I mean, it really leads to some curiosity if competitors can really step in and sell cheaper alternatives. You can only raise prices so much, before it becomes a problem. My issue with MO is it's always been that revenue has been flat for the last decade. Yeah, and it's only been the revenue's declined. It hasn't gone up, actually. And when I mean declined, it's their product volume has gone down. The business has declined. They just make it look good in revenue because they increase prices. That's how they fought the declining smoking generation. You got to just be super, super careful. Hot take: Google, YouTube is more addictive than cigarettes. I 100% agree. I am buying Google primarily, and I think it's not the best reason to be buying it because YouTube is not the most. I feel like they could do a lot of things to make YouTube much more, income oriented. They know most YouTubers make their money off sponsors. They could easily increase. Right now they do a 50-50 split. I honestly think you could increase the ad, percentage. They could give out 30%. It'd piss everybody off, but everyone would still be using YouTube because of sponsorships, right? I mean, Google's got so much growth ahead of it. YouTube is the premium platform above all streaming. I hate listening to people gloat about Netflix and Disney. I'm like, you understand the comparison from YouTube to streaming? They lose so much damn money trying to make shows that people only give a shit about for the hour they watch it, and then they move on. I have been watching the same YouTubers since I was like 16. I'm like, there's been YouTubers around that have been around since the dawn of YouTube that still post crap because it is how they make their living, and it keeps you coming back. It's like watching a regular sitcom, for crying out loud. It's an endless loop of we're going to keep you hooked on the ball and chain. And Google doesn't make any content. They pay for nothing. They pay for zip, and they just print insane margins. If there is one business I'd love to own, it is YouTube. And I do, because I bought Google. I always get so heated when people shit on YouTube. I'm like, are you kidding me? You really think Netflix is the superior streaming platform? I'm like, what are you smoking? Because it ain't any of Altria Group's products, damn it. Anyways, I think we're going to finish up here. I'll get into a few more of these real quick. I always try to see how the company will do in 20 years. Mo cannot see doing well in 20 years. Yeah, I think we got through some of these. It's more about vaping nowadays. 100% agree. Blah, blah, blah. You guys added any more comments to this that I can move on here? I mean, yeah, no name. Even if you do smoke, the funniest thing, not that you're relating to this, but the funny thing is like people are going to no name for everything. People go to the Indian shops now to buy cigarettes because they're cheaper. People going to no name chip brands. I go to the dollar chip aisle in Walmart. Ain't nobody spending money on this crap like they used to. Speaking of Hershey, what do you think? I'll finish up with the Hershey, because Hershey is one of my favorite companies because the candy industry, like Warren Buffett says, it's owned, it's monopolistic in its behavior. And it's something that I've actually been looking at and buying. I think there's good value in it right now. I think some of their products are getting a bit expensive, but at the same time, like a lot of those products still end up in the dollar store. Like Hershey has a lot of products that dominate the dollar store. They are the monopoly amongst many other monopolies. Like I think if there are a true monopoly that exists out there, Hershey's probably at the top 5. Forget like Apple and all those companies. Hershey, like I think is literally, because if they don't own the product, they are licensing it to basically make the product in certain countries. I think the more you look into this business model, the more it blows your mind that they own every holiday. And again, over Christmas, I've been eating so much junk food. Like who owns like Ferrero Rochers and that stuff? I mean, those companies continue to excel. I mean, Lindor chocolates do well. I'm curious to if Hershey has any kind of, any play in that. But look at even just looking at the quick financials here. The revenue's up 11%, net income was up 30%, diluted EPS was up 30%. This company, I think, even if it stalls out for a while, I might have to buy this. It's a good diversification method to get outside of the U.S. markets as well. I think Hershey is primarily a European company, isn't it? What's their balance sheet look like? I think they have a bit more debt, which might be hitting them a bit. Not bad, 6 to 11 billion. It's not like the best balance sheet ever, but it's not terrible either. That's income. Sorry, their income, their balance sheet. Yeah, no, sorry, they do have a lot of debt. 7.6 billion versus 10.9. So they do have a little bit more debt. Let me share that real quick. Can I share that? Yeah, you guys can see here. Hershey, I don't know. It's one of those companies where they can have a bit more debt on the balance sheet because they can print so much money and their business is so damn reliable. But yeah, I don't know. Look at this, from 8 billion in 2020 to 11 billion expected this year. You look at how crazy that growth is on a candy company. I love Halloween though. I'm a Halloween junkie. It is based in Hershey, Pennsylvania. Is it? Is Hershey a U.S. company, or is it I thought it was primarily a European company that just has some or maybe that's Nestle. Am I thinking about Nestle, another good company? I mean, these are the ones you want to look at. I think these ones are very intriguing. Like Nestle, yeah, this is the European one. Very intriguing stocks, to say the least. I should do a full breakdown and analyze their earnings call. Dollarama is still a good buy. They're very expensive. Dollarama is another fun one to look at. Let's take a quick peek at this one and then I'm out of here. Dollarama is probably one of the best performing Canadian stocks ever, but it trades at a really high multiple. And honestly, yeah, I don't know. I have a hard time wrapping my head around this one. Back in the day, I thought about buying it as a recession-proof business, and it's truly showing you that it is a recession-proof business. It's just a matter of, I honestly, because when I think about Dollarama, I think about Costco. And when I think about what of these two I'd rather own Costco over Dollarama. Costco trades at a bit of a heftier premium, but I think Costco is just a better business than Dollarama, but they're both great. They're much better than Walmart is. I think Costco and Dollarama are much more better businesses if you take a look at them. Thoughts on PayPal, God? You guys got to stop me going down these rabbit holes. Okay, last one. PayPal stock. PayPal is a company that I think is overhyped by a lot of YouTubers, and I think they are dwindled by competition. And as somebody that deals with foreign currency, I don't like their business, and I did everything I could to avoid using PayPal. And I come from a negative mindset of somebody that uses the business, but again, at the same time, they are a cheap valued company. There's just so much competition and people don't recognize like Apple Pay and all this stuff. And, basically I used to love PayPal because I made international income, and PayPal was my primary source to collect US income. And I used to transfer that US income from my PayPal account to my US banking account. And then one day PayPal said, hey, we can make more money by charging conversion fees if we stop letting people pull their US dollars out of their frigging PayPal account. So now if I take my US dollars out of my PayPal account, it auto converts the currency and I can only transfer it to my Canadian corporate bank account. And I lost my effing mind on them. I actually called them and I bitched at them. And you know what they told me? Too bad. So you know what I told them? F you, I'm going to do wire transfers. I don't need you. And now basically every US business I do where I'm doing large transaction values, like I'm using wire transfer. You can absolutely suck. I don't want to get too pissy with PayPal, but PayPal honestly rubbed me the wrong way and they pissed me off so bad that I realized the business is obviously just fighting for margin these days and they're out of their growth era because everybody's running. You got Square. I mean, there's so many companies that are running payment transaction things today that like PayPal is going to have a hard time competing unless they start getting into a lot of different growth vectors, but I don't know how they do that. Apple Pay is like I think on a security level, I was just reading an article, like Apple Pay is like one of the most secure things you can use. Nobody uses them for transfer. I don't know. I'm not a good person to go on about this because I like PayPal, the business. Like I get it. I get the fundamentals. I understand that it's cheap valued stock, but you can see that they are doing nefarious things to keep their business going, right? And that just shows a sign of a mature business, not a growth business. And I could be wrong. Maybe they come back. I don't know. Let's just take a look because they've done very well. I mean, don't get me wrong here. Take a look at the income from 21 billion to an expectation of 29 billion. I mean, that's still a good growth business, right? I just don't think that growth is coming from like new user acquisition. Because even when you look, I think last time I looked through their investor presentation, a lot of their growth is coming from margin expansion and just trying to find a way to make more money off the users they have. And, they do have a lot of debt too. Like they have quite a bit about liabilities, but I think those liabilities are the assets that people hold in cash. Because I think they have to put down the cash you hold in your PayPal account as a liability. I could be wrong, but I'm pretty sure that's part of their liabilities. I don't know. I could be wrong. PayPal could shoot up and I'll be like, okay, I get it. you piss someone off once and it's hard to get them to like the business. What are your ETF options for your RE or RRSP? I'm presuming you're saying. We'll get into that a bit later, folks. I do appreciate you all showing up this evening. I'll finish up with one more here. I'm 40 and I'm finally going to start putting 150 a week in the market. Would you suggest just putting it all into SEHD or split it into other ETFs? If you're 40 and you're only just starting to invest, please, you got 20 years of investing ahead of you. I mean, my parents only just retired and they're 65. I mean, just don't undersell yourself here. No, there's still a lot of growth in this market. And just don't focus on things like SEHD and dividend-oriented companies, because I really feel like at 40, you're losing out on more time than like someone that like my age that's 30 to kind of take advantage of that. So just diversify your money. Look at the S&P, look at some other options, and just keep yourself going. But maybe we'll do a deeper dive on that later. But stay cool, stay awesome, folks. I appreciate everyone stopping by, and I hope you're all having a great start to the new year. Peace.